Another short-term managerial decision that business managers have to make is whether or not to accept a bid from a potential customer at a special price. In other words, to offer them a reduced sales price on a one-time order. If this situation occurs, the first question that managers should ask themselves is, do we have excess capacity? In other words, do we have the ability to produce and sell more units than we're currently making now? And that's very important, because if your company is producing as many units as it has the means, the skilled workers, the machinery, etc., to make, and it's selling every single one of those units which it's producing at full capacity at its regular sales price, why would you sell to somebody else for less? Why would you purposely choose to not sell to someone at full price and instead sell to someone at reduced price? So the first point when you have this decision to make is, are we at full capacity? If the answer is yes, then you should never accept a reduced sales price. If you do have unused capacity, if you have the ability to make more product than you currently are, you have the time available for your workers and you have unused machinery, etc., well, then it becomes a matter of profitability. What is the cost going to be of fulfilling that special order? What do you have to pay in production to make those goods for the company that wants that one-time order at a reduced price? And is that sales price that you're going to receive going to cover your costs and ultimately leave you with more profit? That's the quantitative end of things. The qualitative end of things is to think about what effect this is going to have on your other business relationships. If you're going to start giving people a reduced price, are the rest of your customers going to expect you to reduce your regular sales price down to the special price that you intended originally to be a one-time order? Yeah, you might make a little bit of profit in the short run off that special order, but if everybody else expects you to sell at that lower price and therefore reduce your margin, well, you're going to be less profitable overall in the long run. We have Smart Touch Learning's budgeted income statement. You've already seen the contribution margin format on the right. This slide is also giving us the convenient traditional format on the left, where instead of separating variable from fixed costs, they're separating inventoriable costs as cost of goods sold to period costs as selling and administrative expenses. But as you can see, it doesn't matter what the format is, you're always going to end up with the same bottom line. So basically, you're just breaking down how you want to display your costs. Well, no matter what format we use, Smart Touch Learning is budgeting to make $236,000. If somebody calls up and says, hey, Smart Touch Learning, we want a deal on some of your tablets, that number better be increasing your operating income above $236,000. There's no reason to do it if it's going to result in you being less profitable during the period. So let's say somebody calls up Smart Touch Learning and they say, we want to get some of your tablets. Say it's a chain store that sells electronics, and Smart Touch really wants to be on the shelves in that store. And the store calls up and says, we want your products, we want your tablets, but we want to do a trial run. We don't want to pay full price for this. We want to make sure that we're going to be able to sell them before we make bigger orders at a full price. We're only going to offer you $275 for each tablet that we purchase from you. We want 250 tablets. Well, Smart Touch sells these tablets at $275 a piece for the 250 of them. They're going to make $68,750 in revenues. Now let's also assume that the variable manufacturing, very important, not just all variable costs, but the variable costs specific to manufacturing, the extra materials and labor and variable overhead that we're going to incur for making these goods, comes out to about $245 a unit. Therefore, to make those 250 units, Smart Touch is going to have to spend a total at $245 a piece of $61,250. So, breaking this down, doing a differential analysis between our two decisions, if we accept this special price, the amount of revenue that we are going to bring in exceeds our additional cost by $7,500. And in the long run, there should be an expected increase in operating income. Why don't we have any fixed costs in here? Because they're not going to increase with the additional production. Why don't we have any variable costs related to selling and administrative? They're not going to increase with this production as well. We're still paying whatever our variable administrative costs is, our hourly wages of administrators, the same, because they're not going to have to work extra time for this extra order. For selling, it's not like we have to pay more for advertising. They came to us and asked us to sell to them at that special price. So the only thing that's affecting is the variable manufacturing costs. And under this rule right here, taking this job on, fulfilling this special order of 250 tablets and selling them at a reduced price is still going to lead to us making $7,500. Let's assume here then that our decision alternative is to take this deal, to sell at a reduced price, or to tell them no. Well, what happens to our overall profitability in those two decisions? If we say yes, we make an extra $7,500. If we say no, well, then we're not using any of that unused capacity. That's no increase in revenues. It's no increase to variable costs because we're not making any units. It's no increase to our operating income. So the question we're really asking ourselves is, do we want to make $7,500 or not? And assuming that this isn't going to have an effect on our other sales, we should say yes. So as a rule of thumb, just from the quantitative numbers, if our expected increase in revenues is greater than our increase in costs, we should fill the special order. We should sell to them at a reduced price. We have the unused capacity. It's better than doing nothing. If the price they want is so low that it's going to cost us more money to produce it than we're going to eventually sell it for, but then that doesn't make any sense for us, we will reject that special pricing order.